Welcome to This Explainer. We're jumping right in today with a deep dive analysis of Kohl's, trying to answer one big question. Does this beaten down retailer actually have what it takes to pull off a massive turnaround? So let's start with what Kohl's actually is today. At its core, we're looking at a huge omni-channel operation built specifically for the value-conscious shopper. We're talking over 1,150 physical stores as of early 2026, plus a massive e-commerce side. They sell a bit of everything: apparel, footwear, home goods, and as we'll see, beauty. But look, it's no secret the market has been highly skeptical of this company lately. Wall Street is looking at these deep structural issues, basically wondering if management can even stabilize sales in a world completely dominated by Amazon's convenience and the in-store treasure hunt you get at places like TJ Maxx. And you know, that intense skepticism, that actually sets up the absolute perfect stage for a classic deep value turnaround analysis. Now, the whole thesis we're breaking down today really comes down to a classic turnaround formula. See, when a stock is this beaten down and heavily shorted, you don't actually need revenue to suddenly explode to all-time highs for the investment to work. It's way more pragmatic than that. You literally just need the revenue to stop falling. If it stabilizes and you combine that with normalizing margins and super strict cost discipline, well, the math takes over. Because expectations are currently sitting in the basement, pulling those three levers results in disproportionately higher earnings. And that is exactly what can dramatically re-rate a stock price. You really don't need a miracle here. You just need competent execution.
So to figure out if Kohl's can actually stabilize that revenue, we need to look under the hood at what people are actually buying. When we break down their $14.8 billion in sales for FY 2025, we see a really distinct, almost opposing trend happening. Traditional apparel, that's a heavy anchor right now. Women's, men's, and children's clothes all posted pretty significant declines. But then look right over at accessories. This category, which crucially includes Sephora, actually posted a 2% gain. And honestly, this divergence right here, this is the central tension fighting for the soul of Kohl's entire business model right now.
And that brings us to the sheer scale of their biggest growth driver: over 1,100 locations. That's how many Kohl's stores now feature Sephora. If you look back historically, traditional department stores always struggled because they lacked a really powerful beauty traffic generator. It was a massive gap. But now, Kohl's has 855 full-size Sephora shops and nearly 300 smaller formats. Let's be clear, this rollout is not just some small experiment anymore. It's a massive, foundational shift in their physical footprint, engineered specifically to attract younger shoppers and drive high-frequency visits. Because this Sephora integration is so huge, the question isn't, will Sephora work anymore? The analyst brings up a much more pivotal point. Can Kohl's actually use that beauty traffic to revive the rest of the store? I mean, if you're thinking about investing in this turnaround, this is the single metric that matters most. Getting foot traffic is great, obviously, but if a shopper walks in, grabs a tube of mascara from Sephora, and walks right back out without ever looking at the apparel or home goods aisles, well, the strategic benefit to Kohl's bottom line is going to be pretty minimal. A true successful turnaround absolutely requires converting that beauty traffic into broader multi-category baskets that actually move the needle. Now, while the revenue side of things is clearly still an ongoing battle, the margin side of our turnaround formula, that's showing some real, genuine signs of life. If we look at the latest Q2 FY 2026 results, there's a striking bullish catalyst. Gross margins expanded by an impressive 305 basis points, hitting 43%. Listen, in the razor-thin margin world of retail, a 3% jump is massive. It literally means management is squeezing noticeably more profit out of every single item they sell. To put that into perspective for you, if Kohl's just manages to stabilize sales around $15 billion, a sustained margin improvement like this creates roughly $300 to $450 million in extra gross profit. That is a massive, massive tailwind for their earnings. And that margin improvement, paired with some pretty strict cost cutting, like a slight decline in SG&A, led management to materially raise their full-year guidance. They're now projecting an adjusted operating margin approaching 4%. Plus, they bumped their adjusted earnings per share up to a range of $1.80 to $2.40. On the surface, I mean, jumping from a $1 outlook to nearly $2.50, that looks like an incredible, indisputable victory for the turnaround strategy. But as we start to peel back the layers here, a really stark contrast emerges between those flashy headline earnings and the actual underlying reality of the business. You know, when you're analyzing a deep value stock, it is so incredibly easy to get blinded by a sudden jump in guidance. You see a number go up and you just assume, great, the core business is fixed. But we have to stop and ask together,
Where exactly did that extra profitability actually come from? Was it really from selling more clothes efficiently, or was there something else entirely going on?
Well, here's the major plot twist. Roughly $150 million of that Q2 upgrade did not come from selling more jeans or sneakers. Nope, it actually came from a non-recurring tariff refund. It's this massive one-time cash injection that essentially acts like financial makeup. It makes the headline numbers look significantly better than the day-to-day retail reality actually is. Because of that, it is absolutely critical to base your valuation on what we call normalized earnings power. Normalized earnings strip out all that noise. They exclude those temporary windfalls, like a one-time tariff refund. Look, if you're trying to figure out what Kohl's is realistically going to make in 2027 or 2028, you simply can't extrapolate that tariff benefit indefinitely into the future. That 1.80 to 2.40 guidance range, it's inflated. You've got to strip away the noise to see how the actual engine underneath is running. And this distinction between headline illusions and underlying reality brings us perfectly to the balance sheet. Right now, at a trailing PE of around 7, the stock looks like a screaming bargain. But it's kind of like an iceberg. Cheap equity, which is just the stock price you see on your screen, is only what's visible above the surface. Below the water, you've got to factor in the massive weight of their debt and lease obligations. A cheap stock price does not automatically equal a cheap enterprise value, and that's a trap a lot of investors fall into. So let's do a reality check on that balance sheet because it's honestly pretty sobering. In FY 2025, Kohl's issued $360 million in senior secured notes. And the kicker here? Those notes carry a staggering 10% interest rate. Guys, that is edging dangerously close to credit card territory for a major corporation. A double-digit rate like that is a glaring alarm bell from the market. It proves that institutional creditors view Kohl's as a highly risky bet. And this heavy debt burden makes the whole turnaround so much more complex, simply because financing that debt is incredibly expensive. Now, on a slightly more encouraging note, despite that expensive debt, Kohl's has proven they can still generate serious cash. Adjusted free cash flow rocketed up to $935 million in FY 2025. I mean, that is a phenomenal improvement from the $104 million they did the year prior. But we have to remember that retail cash flows can be notoriously volatile. This $935 million is heavily influenced by working capital shifts. Things like exactly when they choose to pay their vendors or how much unsold winter inventory is just sitting in the back room at the end of a quarter. So while it's fantastic to see that big number, we need to be really cautious and not blindly assume that this is their new sustainable year-in, year-out baseline just yet. So if you're watching this stock, what should you actually want management to do with all that cash? Well, Kohl's recently authorized up to $100 million in share buybacks. But given that massive debt load we literally just talked about, the analyst argues capital allocation should follow a very strict sequential priority. Number 1, pay down that highly expensive debt to lower the company's overall risk profile. Number 2, invest in store productivity and business reinvestment to actually fix the core apparel sales. It's really only after all that is sorted out that they should even consider funding aggressive share buybacks. Valuing a complex turnaround like this isn't about just throwing a single magic price target at the wall. It's really about weighing different scenarios. If comparable sales keep falling and margins start compressing again, the bear case sees the stock potentially dropping down to between $8 and $13. The base case, which assumes they just manage basic stabilization, values the company between $17 and $25. But then look at the bull case. It shores potential value soaring to over $42 a share. That is a massive asymmetric range, which basically means the potential reward is dramatically higher than the floor if, and it's a big if, they can actually pull it off. For that bull case to actually materialize, though, for this stock to become a true multi-bagger, management has to perfectly thread the needle through some very specific sequential steps. Step 1, stop the bleeding. Sales absolutely must stabilize. Step 2, hold the line on those new improved gross margins, keeping them above 40%. Step 3, keep overhead costs, or SG&A, growing slower than sales. If they can achieve that exact sequence, normalized EPS can push past $2.50, and that would fundamentally change how the entire market values this company. However, we absolutely cannot ignore the storm clouds gathering here. The competitive environment is just brutal right now. Kohl's is fighting a multi-front war, with Amazon totally dominating online and off-price giants like TJ Maxx stealing those treasure hunt shoppers in the physical retail world. Frankly, Kohl's economic moat is incredibly weak. Add in the immense risk of persistent consumer inflation, putting pressure on the discretionary spending of their core middle-income shoppers, and you face the very real, terrifying danger that comparable sales will just continue falling, despite all of their cost-cutting efforts. When you tally up all these different metrics, you get a perfect picture of this tension.
On the analyst scorecard, you have these exceptional 5-star valuation marks and strong cash flow potential pulling the rating up. But then, they're heavily anchored down by that weak 2-star competitive moat and a really concerning balance sheet. This all results in a blended overall score of 3.5 out of 5 stars. It is literally the mathematical representation of high risk meeting high reward.
Bringing this all together, the final verdict frames this as a speculative buy. Let's be totally clear. This is not a Warren Buffett-style buy and forget stock that you just tuck away in your portfolio for the next 30 years. If you're an aggressive investor, the play outlined here is to maybe dip a toe in, scale into a position very slowly, and then just wait for concrete, undeniable evidence of debt reduction and positive comparable sales before you increase your conviction. Ultimately, all the financial engineering and expense reductions in the world are going to hit a hard brick wall if the top line just keeps shrinking. So it all comes down to this. Can Kohl's finally stop the exodus of its core shoppers? If they can, the upside here is absolutely massive. But if they can't, is that incredibly low PE ratio just a classic value trap waiting to spring? That is exactly what we'll be watching closely. Thanks so much for joining us for this explainer.